SMSF trustees need to maintain an investment strategy for their fund, and part of that needs to consider the insurance needs of their members as well as of the fund's assets. In this video, Garth details what the super laws require around insurance, tax considerations, and how policies should be structured. If you find this guide useful, please remember to subscribe so you don't miss out when we publish a new video. Please remember this information is general in nature and doesn't take into account your own situation.
When it comes to SMSFs and insurances, there are a few key issues which SMSF trustees need to consider. They need to think about the types of insurances that are allowed inside super. They need to think about what the superannuation laws require of SMSF trustees. We need to think about how to structure insurance policies correctly and appropriately. And of course, we need to think about the tax issues when it comes to insurances. There are also a few compliance and strategy tips which should add some real value to SMSF trustees. So when we look at the super laws and what they require, when it comes to insurance, it's covered within the investment strategy rules. We would know that each year, all SMSF trustees must formulate and implement an investment strategy which is specific to the fund. And as part of that investment strategy, SMSF trustees must consider the need for insurance over the fund members. The important thing here I want you to remember is that there's no strict requirement to take out insurances for all SMSF members. The important thing is that trustees need to consider the insurance needs of the members and be able to show how they arrived at their decision to hold or not hold insurance over fund members. So as part of that sort of consideration, the trustees would need to think about the personal debts of the members, the need to provide any lump sum benefits to beneficiaries of the members, the need to replace lost income of the fund member. Also need to think about the asset for the fund and whether there's any need to have insurances in place to protect those fund assets. And the last one, of course, is if the fund has borrowings, what insurances might be needed to ensure that debt can be extinguished. The important thing is to be able to show that these have been considered and the outcome from those considerations. When it comes to the fund assets and whether or not insurances should be held, there are a few things that trustees need to consider. What I'm looking at here is property assets. So things like building insurance, contents insurance, public liability, the insurances that you would usually take out over a property that you own personally, well, that also needs to be considered for property owned within your self-managed fund. Also, the last point around what the super laws require is the strict obligation when an SMSF trustee acquires a collectible or personal use asset. These are your antiques, your artwork, your jewelry, motor vehicles, your SMSF personal use or collectible assets. There's a strict rule that says that when you acquire one of these assets, you must take out an insurance policy within 7 days of buying that asset. And the policy owner, needs to be the SMSF trustees. When it comes to personal insurances inside self-managed funds, we're looking at your life insurance, which covers death, permanent or temporary incapacity, where an event might occur and the member can't work for a short or extended period of time. The rules allow salary continuance insurance. That covers sickness or accident, where you can't work for a set period of time, and it will then pay you or replace your salary for a defined period of time. As I mentioned, asset protection, we need to think about the assets of the fund and how they need to be protected, and any liability protection. If the fund had a borrowing, how are we going to cover that? So they're the types of insurances that need to be considered when we develop our investment strategy. When it comes to structuring insurance policies, the policy owner is always the SMSF trustee. The policy owner is the name of the trustee as trustee for the fund. For instance, ABC Proprietary Limited, corporate trustee, on trust for the XYZ SMSF. The life insured is, of course, the member of the fund. Make sure you get that right. The policy owner does need to be the SMSF trustee because the policy owner is the one that would usually receive the proceeds when an event does occur. When it comes to structuring insurance policies inside a self-managed fund, you need to be aware that the proceeds on any claim from an insurance policy would be paid into the member account where the premium was funded. So if member one, in this case, funded their life insurance held through their self-managed fund through their accumulation account, then any claim on that policy would be paid into that member one accumulation account. Slightly different. If the premium for member one's life insurance was funded through their pension, then you would expect the insurance proceeds to then form part of their pension balance when that policy is claimed on. So structuring insurance policy is important in getting that right. And when it comes to tax, the insurance premiums are usually tax deductible to the SMSF. And again, you would follow that through from where that premium was paid, so it applies to that member. When a payment is made or when an insurance policy pays out, those proceeds, as I say, form part of the member balance and they go into the account from where the premium was paid. Now, depending on who, if we look at life insurance or the death of a member, there are some tax implications depending on who receives that member's death benefit. So, for instance, if I was to pass away and my life insurance was paid into my member account, and then my member account gets paid out as a death benefit to my spouse, because my spouse is a tax dependent, it's tax-free. But if I was to die and my life insurance proceeds go to my member account, and that member account is paid as a death benefit to my adult children, they can pay tax up to 32% on those life insurance proceeds. Normally, death benefits are taxed at 15% plus Medicare, but when it comes to untaxed super, life insurance proceeds, they can be taxed up to 32% when paid to a non-dependent. So we need to think about who's the likely recipient of our insurance proceeds and take into account those tax outcomes. It might require us to increase our level of insurance to cover that tax, or we could consider maybe holding tax outside of super where there is not that large tax bill which arises, as I said, up to 32%. So if you think about that, if a $1 million life insurance policy was paid out, up to 32% of that could be subject to tax by your adult children on death. So structuring it, ownership of the policies are certainly things we need to consider.
We hope you found this video helpful. SuperGuide members have access to an extended version of this video, which gives compliance and strategy tips, as well as ways to evaluate whether your insurance should be inside or outside super. SuperGuide members also have access to many other guides that help you run your SMSF, from admin and compliance through to investing, pensions, and estate planning. Join SuperGuide today and give your SMSF a supercharge.